share with us how you view like the different types of, or tiers perhaps, the different tiers or types of bank loans or real estate financing that's available for business owners?
So as I work with my customers, one of the things that I like to do is I like to educate them. And the first thing that I will do is, and if you go to a typical bank, they're going to have one or two products that they're going to try to put you in. And if you don't fit in that space, then they're probably going to tell you, well, we're not interested in doing this, or we're not going to be able to get it done. But what I'll do is I put the banks into 4 different tiers. And the first tier, I put the Wells Fargos and the Bank of Americas and the Chase banks. They're in that big tier. They're the big industry, the big companies out there as far as banking goes. But for all intents and purposes, a perfect peg has to fit a perfect hole for them to be able to do something for you. So usually they're and I'll give you an example of the banks and the lending opportunities you have in those tiers. But as an example, someone that would fit Chase or the Bank of America or Wells are some of the bigger companies, the people that have been in business for 2 to 10 years, that are doing very well, that have the trajectory of gross revenues, going off the charts and doing very well. Well, they have some pretty good financing for them, and they're typically, they can do anything up to $100 million as far as applying for loans. The second tier banks are, I call them the wannabe Wells and Chases and Bank of Americas, and those are more regional banks, maybe like Alliance Bank or MidFirst Bank or some Bank of the West or some banks like that are a little more customer service oriented, but they also have some niches for some customers, especially here in the state of Arizona, because we have over 400,000 mom pop shop type businesses here. They're not, maybe gross revenues anywhere from 500,000 to 40 million. They would have products for them, and every once in a while they'll have a product that meets a niche for them, or they'll have a promotion that will compete with the big guys. And then there's a third tier bank or lenders that I call more like community banks. They might have anywhere from 1 to 30 branches. They might be in one state, they might be in a couple states, but they might be privately owned, but they're more apt to doing things. They're going to be more of a relationship type bank. And what they'll do for you is, once they get to know you and develop a relationship with you, they'd be more apt to giving you a line of credit or maybe financing for equipment or something like that. Their rates probably aren't going to be as competitive as the big guys, but they're going to be more flexible, and they're going to be more of a good relationship type bank. And another example is like when we went through a downturn in 2007, 2009. The big banks overnight, mark to market, your property value could have went down 50%. And I had several customers that happened to them. Never missed a payment, but overnight, the loan that they had on their commercial property was now worth, on paper, half of what it was the day before. So the big banks would just go out and try to call the note. Whereas the smaller banks or the more relationship type banks, what they'd done with their customers is they would help restructure that loan to maybe do an interest-only loan for a while until they got back on their feet, or give them a cushion to keep them going instead of just throwing the lever and knocking them out. So the relationship type banks are, I think, a good opportunity for small to mid-sized businesses to start. I always kind of instruct my business owners that it's good to have a diversity in your banking relationship. Maybe you have a big one and more of a relationship type bank that can help you with some of the other things that the other one can't. And there's the fourth tier of lenders or banks that I call more transactional lenders. And there's about 4 or 5 in the Valley, and what they focus on is they'll do SBA 7A owner-occupied type properties. And what they'll do is, if you can't quite meet the qualifying criteria that the typical banks are looking for, then they will actually you can utilize projections to kind of get you to those qualifying ratios. As I tell people, the more you add layers of risk to whatever you're trying to accomplish, to the financing process, if you're trying to get a loan, every time you add risk, say the customer's FICO score is less than 720, then you add an eighth. If they were putting the minimum down, you add a quarter. The more you add risk to not being to service that new debt or that new loan, usually the higher the rate is. So that kind of goes in. When I look at the banks and I look at the different products and the tiers of lending, I look at them as products and a step to get you to where you need to be. So that fourth tier that I mentioned do primarily 7A type products. They're going to be a little bit more expensive.